Welcome, ladies and gentlemen. So welcome to our video. Today we are going to look at the capital asset pricing model. So this is going to be a series where I'm going to explain to you the concept of the capital asset pricing model. This video or this session is going to be delivered by that tutor. That tutor is a private tutoring company, and we provide both private and group tuition amongst other services. So if you want to learn more, you can check our description below. So basically, we need to remember that under Markowitz's model, we have learned about the one fund theorem, right? And the one fund theorem told us that our new efficient frontier is going to be a line which touches which touches the feasible set at a tangent. You can say this is a tangent portfolio, and also crosses at the risk-free rate, right? So this is our new efficient frontier. So basically, that's what we learn under the one fund theorem, right? So if you want to learn more about the one fund theorem, I do have videos about the one fund theorem somewhere else. So again, under CAPM, we also learned that investors, they are mean variance optimizers. It is under the assumption is that they are mean variance optimizers, and that they all agree on the variances, the covariances, as well as the variances of the assets. And another thing that they do is that they also have a unique risk-free asset. What that information tells us is that there is, again, that our investors are rational, and that there is information symmetry, and that the market is efficient. And if that's the case, if the market is efficient, it will be equals to T. So basically, our market is going to be T. Our market portfolio is going to be our tangent portfolio, because even if previously we had our feasible, we had our, even if previously our efficient frontier was this orange line over there, according to the one fund theorem, our feasible set is now this line. And if the market is efficient, it obviously can be here. It can be anywhere there or there. It should be exactly at T, because T is efficient, is on the line, and is the only place where this feasible set is efficient. And that place is called the tangent portfolio, and since the market is efficient, the market will be equals to a tangent portfolio. So basically, in order to find any asset, you will use this equation. So you know that this, you will say, is going to be your risk-free asset over your risk of the asset. So in order to find the returns of an efficient asset, this is the equation you are going to use, right? Where you can write it like this, where you will have it like this. You'll have RF equals plus sigma I times this. And this, we often call it the MPR, the market price of risk, or they can just call it K. Sometimes they can just call it K, which is also a Sharpe ratio. The market price of risk is a Sharpe ratio for the market. So it basically tells you how much you should get paid for every additional risk that you take. That's what the market price of risk is. It tells you how much you should get paid for every additional unit of risk you take, right? So what if your asset is not efficient? Can you use the same concept to measure the returns of the asset? In which case, yes, that's where the concept of the capital asset pricing model comes into place. And this equation explains that equation, like it explained the capital asset pricing model. So the capital asset pricing model tells you that the returns of the asset depend linearly on the on the systematic risk, right? So there is a relationship between the returns of the asset and the systematic risk beta, where beta is going to be sigma ij, which is going to be the covariance between the market and the asset over the variance of the market. So we can go a little bit further, and then we can learn about our indexes, right? Under our indexes, we learn that there are two indexes. There's the Jensen index. The Jensen index tells you whether an asset is overly valued. It tells you about the value of an asset, right? Value of assets. We can use this to find the value of asset, whether an asset is fairly valued, undervalued, or overly valued, right? So, and in order to find this, you will use the characteristic line, which is going to be equals to R, the returns of the asset, the risk of the asset equals to alpha plus beta, the market excess returns, right? And then you will solve. So given that you have all this other information, you will solve for alpha, right? And then you will solve for alpha. So given that you have this information, so if you can solve for alpha and then you find that alpha is greater than 0, it simply means that this asset, again, it simply means that the returns that you are going to get are higher than expected. And if the returns of the asset are higher than expected, it simply means that this asset is, again, is undervalued. Is undervalued. And if alpha is going to be less than 0, then it simply means that the asset is overvalued. Right? Because the returns are lower than expected. The price that you pay should have been lower, not the ones that we are currently paying. And then another index that you will learn about in this case is the Chappé ratio. And the Chappé ratio basically just tells you whether an asset is efficient or not. It measures efficiency, right? In our case, you can say that you can use it to measure efficiency, right? You can do many other things, but then you can use it to measure the efficiency. The Chappé ratio basically just tells you that for every again, so it just shows you the gradient between the excess return for every unit of risk that you take. So for the risk of I minus RF, for every excess return for every unit of risk that you take, this is your Chappé ratio or your Chappé index, right? And it tells you whether an asset is efficient or not. And you can find it in an equation. You will have the equation like this. You will have IRF over this, and then you'll say this is the Chappé ratio, right? And then RI. So yeah, basically, if you have something like this, so you can just look at this and then say that, and then you can solve for S, right? And then when you find S, if you find that S is equals to the market price of risk, then this simply means that the asset is efficient, right? And then if it is not equals to the market price of risk, it simply means that the asset is not efficient. So we have learned about the market price of risk up there. And then if you do have any other questions that you that you would like me to clarify, you can send them to me, or you can book a private tutor where we will explain these things into details, and then we will also go through examples. And we also have like a team of other tutors who can tutor other subjects like actual mathematics, geometry, calculus, from first year to final year, including mathematical statistics. Yeah, so if you want to book a tutor, please let us know. And also, if you want me to explain more in details. So in this video, I just was rushing through the information. Well, anyway, I hope this information clarifies some information for you, some